March 28, 1990. Peter Lynch walks into his office at Fidelity Investments. He's 46 years old. He manages the Magellan Fund, the largest mutual fund in the world. $14 billion under management. And he's about to quit. 13 years earlier, 1977, Lynch took over the Magellan Fund with $18 million. Most fund managers would be happy to beat the market by 2 or 3%. Lynch? He averaged 29.2% annual returns for 13 years straight. The S&P 500? 15.8% per year. Lynch doubled the market every single year for over a decade. If you invested $10,000 with Lynch in 1977, by 1990 you had $280,000. The same $10,000 in the S&P 500? $64,000. But here's where it gets crazy. At the absolute peak of his career, managing the world's largest fund, making billions for investors, Peter Lynch quit. Why? His daughter asked him, "Dad, will you be at my soccer game this weekend?" Lynch looked at his calendar. Book solid. And he realized, I've made billions for strangers, but I've missed my own daughter's childhood. So how did a guy turn $18 million into $14 billion using 20 simple principles that anyone can use? And why did he walk away at the peak? Let's break it down. Principle 1. Invest in what you know. 1977. Peter Lynch is at the supermarket with his wife. He notices the parking lot is packed with cars, every single spot filled. His wife says, "We should check out that new store everyone's talking about, Legs." Lynch walks in, sees women fighting over pantyhose displays. Most investors would ignore this. It's just pantyhose. Lynch? He goes back to his office, researches the parent company, Hanes, studies the financials. Margins, 40%. Revenue growth, 300% in 2 years. He buys Hanes stock. It goes up 10x in 3 years. Lynch's rule: never invest in any idea you can't illustrate with a crayon. Principle 2. Look for boring companies. 1982. Recession hits. The stock market crashes. Lynch's colleagues are panicking, selling everything. Lynch? He's studying trash. Literally, Waste Management, Inc. His team says, "Peter, are you serious? Garbage?" Lynch's logic: recessions come and go, but people will always create garbage. Boring? Yes. Profitable? Absolutely. He buys Waste Management at $4 per share. By 1990, $48 per share, a 12x return. Lynch's principle: the best stock is a boring stock. If it bores you, it bores Wall Street too, which means you can buy it cheap. Principle 3. Do your homework. Most fund managers read 50 annual reports per year. Peter Lynch? He read 500. He didn't just read reports, he visited the companies, talked to CEOs, walked through factories, tested products himself. 1986. Lynch visits a Dunkin' Donuts in Massachusetts. He notices lines out the door at 6 a.m. Average customer buys 2 coffees and 3 donuts. Store is packed until 10 a.m. He goes back to his office. Calories: if this one store makes $500,000 per year and they have 1,000 stores, he buys Dunkin' Donuts stock. It returns 400% in 5 years. Lynch's rule: behind every stock is a company. Find out what it's doing. Principle 4. Buy when others panic. October 19, 1987. Black Monday. The Dow Jones drops 22.6% in one day. the largest single-day percentage decline in stock market history. Investors are screaming at Lynch, "Sell everything! Get us out!" The Magellan Fund loses $2 billion in paper value in 6 hours. What does Lynch do? He buys more. He sees companies he's been watching for years suddenly 50% cheaper. Ford was $40, now $20. He buys. General Electric was $60, now $30. He buys. McDonald's was $50, now $25. He buys. By 1989, all 3 stocks had tripled. The Magellan Fund? Up 65% from Black Monday lows. Lynch's principle: the stock market is the only place where when things go on sale, everyone runs out instead of in. Principle 5. Hold winners for years. 1980. Lynch buys Walmart at 50 cents per share. His analysts say, "Peter, Walmart's up 200%. Time to sell and take profits." Lynch says, "Why would I sell my best performer?" He holds Walmart from 1980 to 1990, 10 years. Final return? 5,000%. 50 cents became $25 per share. $10,000 invested became $500,000. Lynch's rule: selling your winners and holding your losers is like cutting the flowers and watering the weeds. Principle 6. Ignore the noise. 1985. Every financial expert on TV is screaming, "Recession coming, sell now." The Wall Street Journal, "Market crash imminent." Fortune magazine, "Get out while you can." Peter Lynch? He turns off the TV. He doesn't read market predictions. He reads company earnings. Coca-Cola, earnings up 15% per year. McDonald's, earnings up 18% per year. Pepsi, earnings up 20% per year. Lynch's logic: if earnings are growing 15 to 20% per year, the stock will eventually follow. Result? No recession. The market goes up 40% over the next 2 years. Lynch's principle: far more money has been lost by investors preparing for corrections than has been lost in corrections themselves. Principle 7. Know what you own. Lynch once surveyed 100 Magellan Fund investors. He asked, "Can you name 5 companies in your portfolio?" Result? 94 out of 100 couldn't name a single company. Lynch realized, people invest thousands of dollars without knowing what they own. He created a test. Before buying any stock, answer these 5 questions. 1. What does the company do? 2. Why will it grow? 3. What's the PE ratio? 4. What's the debt level? 5. Why will you hold it? If you can't answer all 5 in 2 minutes, don't buy. Lynch's rule: never invest in a company you don't understand. Principle 8. Look for hidden assets. 1983. Chrysler is near bankruptcy. Stock trading at $6. Everyone on Wall Street says, "Don't touch it. They're dead." Lynch digs into their balance sheet. He finds something incredible. Chrysler owns Chrysler Financial, lending arm worth $2 billion. Gulfstream Aviation, private jets worth $500 million. Defense contracts worth $1 billion. Total hidden assets, $3.5 billion. Chrysler's entire market cap, $1.2 billion. Lynch's logic: I'm buying $3.5 billion worth of assets for $1.2 billion. Even if the car business fails, I win. He buys at $6. By 1987, it hits $48, an 8x return. Lynch's principle: the stock market often ignores real assets. Your job is to find them. Principle 9. Avoid hot industries. 1985. Biotech is the hottest sector on Wall Street. Every IPO doubles on day one. Investors are making fortunes overnight. Lynch's analysts. Peter, we have to get into biotech. We're missing out. Lynch's response. I don't understand biotech. I'm not buying. What happened? 1986 to 1987. Biotech crashes. 80% of companies go bankrupt. Investors lose billions. Lynch? He missed the boom, but he also missed the bust. While others lost 80%, Magellan was up 25%. Lynch's principle. The best place to find a 10-bagger is not in hot industries. It's in boring, overlooked ones. Principle 10. Average holding period, 5 years. Most investors hold stocks for 6 months. Peter Lynch, average holding period, 5 years. His longest holds? Walmart, 10 years, 5,000% return. Ford, 8 years, 800% return. McDonald's, 12 years, 1,200% return. Lynch's rule. Time is your friend. Impatience is your enemy. Principle 11. Buy growth at a reasonable price. Never pay 40x earnings for 10% growth. Find 20% growth at 15x earnings. Principle 12. Check the balance sheet. Companies with no debt survive recessions. Companies with heavy debt go bankrupt. Principle 13. Insiders are buying. When insiders buy their own stock, pay attention. They know something you don't. Principle 14. The 2-minute drill. If you can't explain why you own a stock in 2 minutes, you shouldn't own it. Principle 15. Earnings drive everything. Stock prices follow earnings. Always. Eventually. Principle 16. Diversify, but not too much. Own 5 to 10 great companies. More than that, you can't keep track. Principle 17. Watch for management changes. Terrible company plus great new CEO equals potential turnaround. Principle 18. The cocktail party theory. When your taxi driver gives you stock tips, it's time to sell. Principle 19. Look for the moat. Find companies with something competitors can't copy. That's a moat. Principle 20. Never give up. Crashes happen. Recessions happen. Stay invested. Time heals all wounds. March 1990. Peter Lynch announces his retirement, age 46, at the peak of his career. He chose his family over billions. His legacy? 13 years managing Magellan Fund, 29.2% annual returns versus 15.8% S&P 500. $18 million became $14 billion. Best performing mutual fund in history. Today, Lynch spends his time teaching everyday investors his principles. He wrote 3 books, One Up on Wall Street, Beating the Street, Learn to Earn. Lynch's final lesson: everyone has the brainpower to make money in stocks. Not everyone has the stomach. So here's what you should do right now. Step 1. Read One Up on Wall Street. Go to Amazon. Buy Peter Lynch's book. Read it this week. This book will change how you see investing. Forever. Step 2. The parking lot test. This weekend, go to your local mall. Which stores have the longest lines? Write them down. Research the companies. Buy 1 share. Track it for 1 year. See what happens. Step 3. Learn Peter Lynch's 5 questions. Before you buy any stock, answer these 5 questions. 1. What does the company do? 2. Why will it grow? 3. What's the P/E ratio? 4. What's the debt level? 5. Why will you hold it? If you can't answer all 5, don't buy. Bonus: watch these related videos. If you loved this breakdown, watch Howard Marks' 20 Principles, Warren Buffett's favorite; Morgan Housel's Psychology of Money, Why Smart People Stay Poor; Alex Hormozi's 20 Rules, $0 to $200 million in 10 years. Hit subscribe. We break down legendary investors every single week.